Investors are digesting more earnings from Canadian banks. In fact, the Canadian bank earnings season is now in the books. All of them have reported results, and there are certainly some themes running through the numbers. Today, Royal Bank of Canada narrowly missed second quarter profit expectations on an earnings per share basis. CIBC exceeded expectations, and one stock is down and one stock is up. Let's get some perspective and analysis now from Laura Lau. She's Chief Investment Officer of Brompton Group. Let's start with the Royal Bank of Canada numbers. What did you see there, Laura?
So, usually Royal doesn't disappoint, but this time they did disappoint. Earning, I would say, loan losses were higher than expected, and we've seen that across all the banks. Loan losses were higher than expected, but loan growth not quite what wanted it to be. So I think just not up to the high expectations that people expect for Royal.
Well, one very common theme here, and it's been remarked on numerous times as we've talked with experts about these numbers, is the banks are increasing their provisions for credit losses, but not only on impaired loans, they're also taking the step to cover loans that are right now performing. So they're worried even about their performing loans. But does that raise the possibility, Laura, in a best case scenario, that at some time in the future, some of those provisions are going to come off and go back into profit and be a so-called a tailwind, a push to profit growth?
History has shown that, when people are nervous, all bank CFOs do put more provisions so that in good times they can take it out and boost their earnings. So I think this is another of those cases because, with the economy slowing down, if you didn't do it now, when are you going to do it? People wouldn't believe you if you didn't take these provisions now. So now is the time to do it. You don't get penalized for it. If anything, if you don't do it, you get penalized. So I think it is definitely the right approach to take.
Okay, CIBC exceeds profit expectations by a wide margin. The stock is being rewarded in the market on that basis. Capital markets were a big driver there. Profit in the capital markets unit at CIBC up 20% to $566 million. And the bank also dialed up its provisions for credit losses. What did you see in the CIBC numbers?
So I'd say certainly trading revenue has been better across the board, and that happens when there's more volatility, and we've had definitely a lot of volatility. But then we also see less investment banking, which offsets that. But CIBC, what they also did well was they controlled expenses. I think when in tough times, that's what you got to do. You have to control those expenses. So all in all, I think CIBC was one of the best quarters of all the banks. Okay,
so for investors, despite all this economic uncertainty, despite a parade of banks setting aside more money for loans that might go bad, investors have watched these stocks rally in a big, big way since about the 10th of April. So the TSX Bank Index is up in a very straight line since that period of time. What do you think of the appreciation in the shares we've seen recently and the multiples that these stocks are now trading at?
So I think going into earnings season, everybody's very cautious. Oh, the economy's slowing, but Canadians, we pay our mortgages. So in general, it's especially those that are more, levered to personal banking have done better than expected. So I do think that in general, banks, they're fairly valued. They're not expensive, they're not cheap, they're just fairly valued. And the other thing we did see this quarter is capital levels are still very high, and you see them also increasing dividends, increasing share buybacks. That is a sign of confidence. Watch what they do. And, when money leaves the door, that's real money. That's a sign of confidence.
Okay. One big reason the S&P TSX Composite Index is at a record high is the bank stocks. What are your thoughts on the Canadian stock market right now? Do you still see opportunity in Canadian stocks?
Well, Canadian stocks have actually outperformed U.S. stocks, and people don't really realize that. And part of the reason why is, first of all, it's way, way cheaper than the U.S. stock market. That's one thing. And
on a price-earnings basis?
And on a price-to-earnings basis, we are much cheaper. The U.S. is basically, in terms of valuations, at 90+ percentile, whereas we're about average. So I think that has helped. And also there's been the question of U.S. exceptionalism. U.S. is still the best place in the world to do business, but it's less good I would say, with the tariffs. And Canada, I think, has improved where, with Mark Carney, he's got a more pro-growth agenda going forward. So I think we're at an inflection point where Canada is less bad and U.S. is less good. And it's all about the margin.
The S&P TSX Composite up 6% so far this year. That's as of this moment right now. By comparison, the S&P 500 flat so far this year. And of course, at a certain point, the S&P 500 was well underwater on a year-to-date basis. There's a one-year look at the S&P 500. Talk to us about your thoughts on the market's re-embrace of the tech stocks. They like very much what they're hearing from NVIDIA today. So
NVIDIA, everybody thought their growth was slow. Their growth has been still spectacular, and you've seen Jensen Huang talk about actually, AI maybe reaccelerating. And the next stage, like the first stage was training models, and the next stage is actually let's talk to them and query them. And he's seen that accelerate because that is really more the long-term growth going forward. And he sees, that accelerate. And definitely, he didn't need China, which people are surprised, and we are surprised. Even without China, that demand is increasing. So I think that it's become more and more obvious that it's not just a U.S. story. Canada, we had Bell yesterday, open data, building data centers. Worldwide, we all have to build data centers. We all need to adopt AI.
Okay, another stock market around the world talking about outperformance that has outperformed in a big way is Germany. The DAX index is now up 21% so far this year. Dialed up defense spending, a willingness to spend more on defense is a big part of that story. What are your thoughts on this market?
Well, Germany has come to a pivotal point where they've realized that they need growth. And to get growth, their debt is very low. They can, spend more. And it makes sense to spend more on infrastructure. So we see that they're spending more on infrastructure. That should be at least a 1% boost to GDP every year for 12 years. That's huge for a country that has been pretty flat. Energy costs are getting better. That will help. And then defense spending. For the longest time, Germany's like, they didn't want to see high inflation because they had hyperinflation after the world wars. Now they're like, there is no limit to what they can spend on defense. That is a huge about face. And as a result, we have definitely seen stocks in Europe that are related to defense just skyrocket. And I do think it makes sense because we're definitely at this inflection point.
So do you have European exposure for your clients?
Yes, we do. We have Safran and we also have BA.
Okay. Thank you so much for joining us as always, Laura. Laura Lau is Chief Investment Officer at Brompton Group. Always great to get her perspective.